Ben Reppond. Welcome to my YouTube broadcast. Today is November 1st, 2023, the beginning of the 11th month of the year. We have 10 months behind us. Wow, where did this year go? I always play a piece up front, and I'm going to play one piece for you. This is going to last less than 2 minutes. It's a piece that I played yesterday because it was the highlight of what occurred last week. What occurred last week was the announcement, the coming out of the gross domestic product growth for this past year. And we are on a very fast clip. The economy is growing rapidly. And so Mohammed El-Arian does an interview with Becky Quick, and he covers this, showing that we have a strong economy, but the result of that is that we are going to opening the door for more Federal Reserve rate hikes, or at least another hike. As long as the economy is growing, what they're trying to do is to slow it down. Not too much, but slow it down to the point where we are getting a growth rate or an inflation rate, consumer price index rate of around 2%, or you could even say 2 to 3%. We are running at a rate that is faster than that right now. So I want to play this, and this will give you kind of set the stage for where we are and a summary for what I think was the biggest highlight of last week. Now, I did play this yesterday, so if you watch that, you will see a repeat. But this is what I would say would be the highlight from last week. Take a listen.
Investors are paying close attention to the slide in technology stocks and the volatility in the Treasury markets. And joining us right now to talk more about that is Mohammed El-Arian. He is Chief Economic Advisor at Allianz. He's also the president of Queen's College at Cambridge University and the co-author of the new book, Permacrisis, A Plan to Fix a Fractured World. Mohammed, let's just talk, first of all, about the economy, because we've got the GDP coming out in just about, I don't know, less than an hour's time from now. That's expected to be a strong number, but there are so many questions swirling about the economy. Where do you think we stand right now?
Morning, Becky. I think the number is going to highlight two things. One is U.S. exceptionalism continues. Not only is it going to be more than double the rate of 2.1% for second quarter, but it outpaces all other advanced economies. The U.S. has been the growth engine for the world. It also highlights the challenges the Fed faces. But what we should not do is take this as a signal of the all clear for 2024. As you know, I've always pushed back on the notion that we would have a recession in 2023. I'm a little bit worried about 2024.
Early 2024, late 2024, how do you see this playing out?
It's hard to tell. I mean, we have first the rundown in savings. That's the big issue. Secondly, what's been happening in the interest rate market is really problematic. It's problematic for businesses. It's problematic for governments, for the Fed. It's problematic for households. And that is a significant headwind to economic activity.
Okay, now I want to get into the dashboards, two of them. One is to show the indexes. Now I've got 6 equity indexes and 1 bond index. So the yellow box highlights the changes that occurred last week in all 7 of those indexes. And the pink box shows this year to date, and to the right we have red dots and the 1 green dot. And those show, the red indicates that that these indexes are below their moving averages, going from left to right, the 20, the 50, the 100, and 200-day moving averages. And if it's red, which all of them are except 1, and then that green dot says that 1, the NASDAQ 100, is the only one that is still above its 200-day moving average. So let's look at last week. Very interesting. It was a very negative week last week. The market continued to grind down. What I thought was interesting was that the market sometimes it would open down and then just go on down. Sometimes I don't remember which days, but sometimes it would open up and then collapse and just go on down. So the week finished, the U.S. indexes, the top two, 2.6, 2.5, the Dow down 2, and the Russell down 2.5. All of them, the 4 U.S. indexes, all down about 2 to 2.5%. The 2 foreign indexes were down less, the developed markets down 1%, and the emerging markets down a little less than 1%. The TLT, the 20-year government bond ETF, got a little bit of a reprieve and went up for the week 1.3%, but it has been on a 39-month since summer of 2020 decline, and has declined over 50%. So a little reprieve, letting a little steam off, yeah, that happened. But today, it's down a lot again, the day of this broadcast. It continues to go down. So, and there are people, I mean, this is befuddling a lot of traditional thinkers, traditional financial advisors, financial planners, investment managers. It's really crazy making for a lot of people because they have been lulled to sleep in this last 40-year period from the early 1980 range till 2020, approximately 40 years of bonds continuing to go up. Yeah, they have a little correction, but they go on back up. Why? Because interest rates were coming down over that period of time, generally speaking. So this is having a very negative effect on investment portfolios. You can see year to date at the bottom line that the 20-year government bond is down 15%. Last year, it went down as much as 30% and finished the year something less than 30%. But it is not letting up. It is continuing to decline. And people are thinking, okay, now's the time to stop shorting it. Now's the time to start buying it. And it keeps going down. They've been saying this, and it keeps going down. This is decimating traditional 60-40 buy and hold portfolios. I've talked to a number of people, and the ones I have talked to have said, I think everyone, or nearly everyone, has told me that they are underwater. They are negative for this year. And of course, they were very negative last year, most of them down 15, 20, even 25% last year. And this year, thinking, okay, this year, particularly because the market took off at the beginning of the year, they were thinking, okay, well, now we're back to the races. Not so fast. Stocks are starting to fall apart, come down, and bonds are pulling them down even further. So those who are in traditional portfolios are seeing the effects of the buy and hold approach, that it doesn't work in this type of market. And the being lulled to sleep for 40 years is not a solution for what people are facing now. And I think this is going to go on for, if you look at the history of interest rates and bond yields, both positive and negative, this could go on for a decade or a couple of decades or more. I would say at least a decade and a half. Now, it won't go straight down. There will be periods of time, it's the way the market works, where it will go up, but eventually it's going to collapse. Why do I think that? Because I think we are in for a period of time, a longer period of time, not just this last year or two, but a longer period of time where interest rates are going to continue to increase. And you know, we're not there yet. We're, you know, whatever indicator you're looking at, whether it's bonds or you're looking at the Fed or credit cards or mortgages or whatever, I think we're in for a period of time where they will continue to go up. And I'm not going to cite all the people, but there's a number of people that agree with that thinking. When you look at the year-to-date, the winner by far is the NASDAQ 100, up 29%. That includes the Magnificent Seven tech stocks, the S&P 500, which includes those, and those are holding the entire S&P 500 up, the Magnificent Seven. You take those out, and it's negative. And then, and that's up 7%. The Dow down 2%. Russell 2000 down about 7%. And of course, I said, and bonds are down about 15%. But it's not, and the reasons for all of this is that it's not a growth environment. This is not positive for equities. And of course, we know it's not positive for bonds for the reasons I stated. But equities have headwinds due to interest rates, inflation, debt, and I think there's still quite a bit of concern on the war in the Middle East because that has not fully played itself out. They are going strong, and that is concern for that area. And of course, the implications of dragging other countries into it. There's a nuclear threat, Iran and Russia and China, North Korea. It's got implications that go way beyond just the conflict between Hamas and Israel. When we break the S&P 500 apart, you can see the yellow box again showing the 11 sectors, all negative for last week. And they go from the energy sector, which was the worst hit, down 6%, and the telecommunications sector down 4%. The others were negative, but down less than those two. Year to date, technology, again, similar to what I reported in the previous slide, down 29%. Consumer discretionary down 15%. Everything else is negative. The most negative being what you could say healthcare and consumer staples. Those are defensive stocks. Where are they? They're not very defensive. They are not holding anything up. They are falling quite a bit. And of course, telecommunication and real estate down a lot. So when I look at those red dots, or the dots to the right, there's 11 sectors. There's 4 moving averages. That's 44 chances to be above or below that moving average. 43 out of 44 are below all 4 moving averages. Only one is above one moving average. The S&P 500, this is a chart showing the S&P 500 for the last 18 months. So I drew a line so you could see from the end of July, this is when it started, I think I saw the top being July 31, it has gone down with a pretty sharp trajectory since July 31st. So we're in the range of 3 months of decline. And my sense is it's going to go on down further before it goes back up. This kind of a decline is usually not met with a upward trajectory that follows it. But I'm going to stay away from that, but that is my opinion. The growth part of the S&P 500 is down. So when I put a relative strength chart showing is it going up or is it going down? If it goes up, that favors growth stocks. If it goes down, it favors value stocks. So this, for the last couple of weeks, you can see at the end of the chart that it goes down. So the last couple of weeks have favored value more than growth. But since the beginning of the year, growth has outperformed value. The S&P 500, which is large cap, the largest 500 stocks on the stock exchange, compared to small cap stocks, the Russell 2000, when put on a relative strength chart, if it goes up, it favors large companies, goes down, it favors small companies. You can see the degree of the trajectory going up, favoring large companies over small companies. Now, I've talked about the long-term government bond. TLT is the ETF, and measured. I thought I would put this out all the way out for 42 months. So you could see there are periods of time where it goes up. And this is the way the market works. This is bonds, but the stock market works the same way. It goes down, and then it tries to go back up, and it can't because there's headwinds, and it collapses and goes down. Tries to go up again, and then collapses and goes back down. Now, having said that, I will say that bonds, and to some degree stocks, are in an oversold condition. When they are in an oversold condition, it is frequent, not a guarantee, but it is frequent that they will have what's called a relief rally, and they will go back up for a period of time. But if the same conditions persist that drove them down, they will eventually collapse and come on back down again. And that happened 3 times to the government bonds, and I think we're going to see that unless things change, unless the conditions change, we're going to see the same thing in equities. This is the dollar, the US dollar, and the dollar is by itself a relative to all of the currencies because we are the reserve currency. So when it goes up, it is going up relative to the other currencies, and it has been in a period of going up. And you may think, well, I think the dollar is collapsing. Well, the dollar is collapsing in one sense, but relative to other currencies, it's actually showing strength. Well, I would say this, is that if the dollar is collapsing, the other currencies are collapsing more. Gold has been on a 3-week trajectory, a rapid increase, more so than silver, you'll see that, a trajectory upward. And it is, and so I drew 2 lines here, one to show the long line to show the long-term, a longer term since late last October to present, so that's about a year of an upward trajectory, and then the short term, the last 3 weeks, you can see a trajectory even higher. Silver, same thing. So it has a long-term trajectory of up, but it has not been moving up as fast as gold has. When I compare the two on a relative strength chart, silver, if it goes up, it favors silver. If it goes down, it favors gold. You can see that the trajectory is down, which is favoring gold. Gold is going up that much more than if I reverse that chart and made gold the numerator, it would be, that black line would be going upward. That means that gold is outperforming silver for that period of time. And Bitcoin. Bitcoin had a fabulous week. It did very well, and as I'm recording this, it's doing very well again today. We got in Bitcoin at the end of the previous week, so we were in Bitcoin all of last week, and we're still in Bitcoin in our crypto strategy, and have been benefited from this kind of move up, and our clients have benefited from it and that are in that strategy. I don't know. I really, Bitcoin does its own thing. It's kind of like gold and oil. I mean, they do their own thing. So where's it going to go? I don't know, but I can tell you right now, it's got, seems to have a head of steam, and we'll see where it goes from here. Volatility has gone up. Now, last week was a down week, but it's interesting. This is the index is called the VIX, VIX, a volatility index. And usually when stocks go down, this goes up. But that typically happens when stocks drop rapidly. And then it goes down when stocks climb or climb rapidly. It's looking for the acceleration of volatility. What's interesting is that last week, you see that at the very end of the chart, that little tick down. Last week, as I showed you, was a negative week, and you may say, why did the volatility index go down when stocks went down that much? Here's why, in my opinion. Because stocks did not have a sharp trajectory down. They just ground their way down day after day last week. That does not tend, that behavior doesn't tend to push the volatility index up. The previous weeks we saw a much more a strong trajectory, and that pushed the volatility index up. Asbury 6, the metrics measured by Asbury Research, there are 6 of them. You can see the dates, and they are all negative, and that's no surprise, because when you saw the charts and the data, no question, everything is negative. They also do relative performance of one asset versus another, so I'll cover this. The stocks versus bonds. Bonds, remember, I showed you at the beginning, they had actually a positive week last week for a change. And stocks were negative. And measured over the last week, the last month, the last quarter, bonds, while they've done poorly in general, they have done less poor than stocks. High beta and low volatility stocks. Low volatility is doing better than high beta. And blue chips, namely the Dow and value stocks, are doing better than the broad market. And again, all of these relate to previous charts that I showed. Emerging markets did better than all the other indexes, as you saw from the first dashboard that I showed you. Emerging markets did better than everything else, including the U.S. and including developed markets. But they had been beat up. Prior to this, they've been beat up quite a bit. Government bonds have done better than corporate bonds, or in some time periods, less worse. And short-term bonds have done better than long-term bonds. The U.S. had a hard week. And for the last week, the last month, and the last quarter, here's the countries that have outperformed the U.S. Brazil, Peru, Spain, the UK, Malaysia, Japan, Hong Kong, Taiwan, India, China, the Pacific region, Australia, and the emerging markets. That's a lot. And the U.S. did better than Canada, South Korea, and New Zealand. That's it. Gold, as I showed you, had a good week. It is now broken above the 2,000 barrier. That's kind of been a magical period or space. So it's now in positive territory above 2,000. And silver is 23.17. Gold went up 3.8. Silver went up 1.7. The gold-silver ratio is 86 to 1. Gold being 86 times more expensive than silver. And this favors, at this level, favors silver as a better buy, a better potential long-term value. The monster box, 500 rounds of silver, generic silver, is now valued as of Friday at $12,710. This includes a markup of $2.25, bringing the cost per round to $27.42 for 500. If you buy a tube of 20, the cost is $25.92. Now, I get this data from my son, who is in that business. Now, these are his prices, so I think they're very good prices. But the reason I give them to you is because I encourage you to buy local, if you can, to buy from a brick and mortar company. And it's kind of silver and gold are kind of generic products. I mean, there's not an ounce of silver is an ounce of silver, et cetera. So there's not any value that they necessarily add, other than the fact that I personally like to buy local and I like to buy from brick and mortar. So these prices give you a benchmark to say everyone does it differently. The spot price is the spot price, but what is the markup? And what is the markup on 500 versus 20 versus one. So it gives you information that will be helpful to you, I hope, in doing your shopping if you want to buy some silver or gold. Well, yesterday was Halloween. I'm a ghost, I'm a witch, I'm a bear market. Which one looks scarier? Well, the bear market has been coming out strong for the last 3 months, and I don't know where it's going. Mike Wilson, the Chief Investment Officer of Morgan Stanley and the U.S. equity strategist, came out today with his podcast, and he said he has been persistent on the fact that the S&P 500 is going down to 3,900. It is broken down through 4,200, but if it goes down to 3,900 and he is sticking with his forecast, by the end of the year, it will be down to 3,900 according to Mike Wilson. So what that means is probably something in the, if that occurs, that's a further decline of 5, 6, or 7% in the S&P 500. And based on what I covered yesterday, if that is Apple stock kind of leads the way and breaks down further, it's probably going to push the tech stocks down further than the S&P. But that's just, kind of a 2-month view, saying that's going to mean not a very good November or December. A lot of earnings are getting reported this week. So if that happens the way Mike Wilson thinks it's going to happen, then we're in for not a very positive November and December. But anyway, I don't wish the market to go down. I hope it doesn't go down and it goes up. But what I do know is that when it does go down, and it goes down enough and gets the excess out of it, washes out some of the weak players in the market, then it becomes more ready to take off and have a period, a positive period in front of it. So if that does happen that way, it, in my opinion, says that in 2024, maybe it doesn't begin with January, but sometime in 2024, the market has a better chance to take off and to shed some of the weight that is holding it down. Thank you for watching. If you have questions or comments, leave them in the comment section below. Thank you.